Hey, everybody. Welcome back to another episode of Not Financial Advice. My name is Sean, and today is Thursday, May 9th. We're a couple moments away from the end of the trading day. And on today's video, we're going to be talking about how to spot a horrible stock, something that isn't often talked about here on YouTube, but I'm going to show you how to do it. Today, we're going to be covering Roblox, Peloton, AT&T, as well as Ford stocks, and we're going to get into it right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
So I'll ask you to like the video and subscribe to the channel. Let's do a super fast update on how the portfolio is performing today, sitting at about $78,600. I am up 0.82%, beating the market, which is up 0.5% here. And we're seeing some outperformance from cannabis investments here and here. Williams Sonoma is printing big time for me here. We also have Target and Starbucks, some great stocks that I featured in a video a few weeks ago or a few days ago. So as far as the stocks that are performing poorly today, we can see Airbnb. We have a spinoff here of 3M, I believe it is, Tesla, Salesforce, and Kroger. So not really a rhyme or reason necessarily, but overall the market is broadly higher. And that's how we want our portfolios to move, is broadly higher. But what can weigh down a portfolio? What can hurt you as an investor? What is total capital loss? Let's get into it. So first, we're going to take a look at Roblox stock. And as we can see here, it is down some 77% from all-time highs. And this is a video game company that's broadly associated with the phrase metaverse. It's sort of a alternate reality game geared towards children and teens. And we can see it was real hot there in the end of 2020, 2021, and has now lost over 77% of its value of its market cap. And so why could that be? So we're going to split this sort of into two categories. First, we're going to talk about high flying, high growth, high valuation tech names that are not only horrible stocks, but businesses and investments. And so this will be one that we start with. And so they're down 22% today. They had a quarterly result and issued poor guidance. But zooming out, looking at the big picture, what we can see here is you've got a forward PE of 192, which is preposterous. Free cash flow yield is negative. And really, the picture is painted just when we look at some of these numbers. So this is where people get into a bull trap, or they get trapped. We can see revenue's been growing at a rate of 54% year on year for 5 years. And so that's an eye-catching top headline number, and that's what draws people in. But let's take a look at some of their different metrics on profitability. So we can see free cash flow here is mildly up and to the right, although inconsistent. So they were higher here, lower here, much higher, much lower, and then recovering not as much. That's not a V shape. It's like a hockey stick, but in the wrong direction. And so we can see their profitability isn't great. And what we can also see here is that even when they do make good profits, they are paying their executives with shares. So they're diluting shareholders through stock-based compensation. So let's just take a look at this, and we can see, here in 2021, for instance, how much was eaten up. And even when they're losing money, the more money they lose, the more they give their CEOs and a CEO and board members. So when we look at this adjusted for stock-based comp, this is a company that is hemorrhaging money. They can't produce real profit. So that's the first sign that you're looking out for. Now, let's also take a look at some other things. So we see earnings per share going lower. The cash and debt, that doesn't look overly bad one way or the other. But what we can see here, this is going to be another one that really hurts stocks. So dilution. So every year for the last 5 years, they've printed 3.22% more shares. So if you bought the company 5 years ago, you've lost 3% of your ownership year on year. So like the opposite of inflation in a bad way. Returns on capital employed are negative, and profit margin is negative and getting worse. I think you get my point. So sky high valuation, bad business, bad investment. Now you know. Also, if you like the video, subscribe to the channel. And now let's take a look at our next sort of bull trap, rather, a high flying name, which is Peloton. So down 97.3% from all time highs. This is likely total capital loss. When you lose 98% of your money, you have to make hundreds and hundreds and hundreds or thousands of percentage points just to get back to even. And so this was a big winner in the early part of the pandemic, and now no one cares. Fad exercise. Do you remember the Bowflex? So exercise equipment can definitely be a fad. I would never touch it. But yeah, the stock is having a lot of troubles. We can see the high forward valuation, 154 PE. Just stay away from anything that looks like that. But additionally, let's see, maybe there's something good we can find here. So revenue's grown 45% a year, last 5 years, year on year, but we see now 2 years of declining revenue. So it was attractive when we went from here to here, but this is an issue. And you have to have that foresight of thinking about what type of moat does this company have. Let's look at free cash flow. It's negative. How much worse can it be with stock-based compensation? Even worse. Horrible. Horrible. Peloton stock, negative earnings per share, more debt than cash, diluting shareholders here by to the tune of 8.2% a year over the last 5. Disgusting. Substantially negative returns on capital, losing 45% on the bottom line. It's horrible. Like the video, subscribe to the channel. So now we're going to sort of switch gears into the second part of this presentation, which is looking at, quote, value stocks, or what in this case would be value traps. So we don't do a lot off price charts here, but if you're looking at a stock that is down 25 years later, that could be a bit of a hint. And that's what we see here. Now, I won't lie, I do own one that looks similar to this. Walgreens as well as Intel. We're going to see if I lose all my money in that over the next 5 years. One of them I am thinking will do okay, but I'm susceptible to this too. And these are lessons I've learned with my money, so you don't have to. So like the video, subscribe to the channel. AT&T is down 61% over 25 years. Not a great sign. Looking at AT&T and sort of their company's performance. Now, here what we see is very different. So a very, very low, very, very low, payout ratio, or PE ratio rather. So the market trades at about an 18. There can definitely be great stocks that have a 7 or a 10 payout ratio, but start looking a little bit closer. Anything that's, half of what the S&P 500 is on a PE basis, you should look at that with a little bit of suspicion. They do have some free cash flow. No one wants to pay anything for it. So they have 17.3% free cash flow yield. Now, this is another area. Whenever you see dividends at or above or near 60%, watch out. So they're at a very, very high dividend yield of 6.5%, but they're knocking on the door of a 60% payout ratio. This dividend isn't safe. We're going to touch on that a little bit more in a second. Let's look at revenue for AT&T. So over the last 10 years, their revenues declined 0.5% a year, but there's also been 2.5% inflation. So it's actually declined 3% a year in real terms. So declining top line revenue is something that you don't want to see. That's a sign of a bad investment, a bad stock. And so this is relatively stronger. Free cash flow growing at 4% a year, just beating inflation over the last 10. But we've seen since 2019, so before the pandemic. So this is not related to that historical event, but just a strong downward trend on free cash flow, with losses in free cash flow over the last 5 years. So declining free cash flow, we hate to see it. Looking at earnings per share, what we're going to see here is just inconsistency. And we see that there was an upward trend, and now we're seeing a declining and breaking down, a downward trend on earnings per share. Whereas they had 2 negative years for earnings per share when I was in kindergarten, they're now having that same thing 25 years later. You don't want to see that. 50 times cash to debt, don't buy anything like that. Dividends, so they were paying about a 10% dividend, and then it got cut. It was well over 60%. That's what you're going to see is a dividend cut. And in fact, they had done it before. So dividend cuts are another horrible sign. It's tied in closely to that payout ratio. Let's look at shares outstanding on this value trap company. They've diluted you by 3% a year over the last 10. That makes stock prices go down. Let's look at returns on capital employed, broadly down and to the right, which is bad, under 10%, which is fairly bad. Looking at profit margins, same thing we see with EPS declining and deteriorating in a bad way since 30 years ago. So let's actually look at its historic PE valuation. Let's look over the last 10 years. So in this case, with a potential value trap, seeing the PE ratio go down, that's actually a warning sign. So now we know. All right, like the video, subscribe to the channel. We're going to take a look at our last sort of value trap, dividend trap, bear trap stock. We have Ford. They make cars. It's very complicated. There's a lot of competition. There's not a lot of profit. There's a lot of regulation. Those are all headwinds. Down 65.4% since 25 years ago. You hate to see it. Not a good sign. So let's see what else lets us know of telltale signs of bad investments. Super low PE. That's, it's a cheap company. Sometimes things are cheap for a reason, right? So let's go through this. Revenue is up over the last 10 years, 1.83%, yet inflation has been 2.5% over the last 10 years. So in real terms, their revenue is declining. Free cash flow, look over the last 10. So it's going down. That's bad. Earnings per share, inconsistent and trending down. High levels of debt. Dividend cuts. It's a negative price catalyst. They're not hurting people too much on the shares outstanding or on the dilution. So even without them doing those two horrible things, the business is just rapidly deteriorating. Returns on capital declining south of 5%. You saw that trend. This is horrible. Bottom line profit margin of 2.5% and just all the cyclicality. So it's a bad investment. Folks, this is Sean, not financial advice. Market should be closed now. Let's see how I did for the day. So market closed. Market closed how much? Up 0.51%. I was up 0.86%. Weed stocks, Sean, not financial advice. Thanks for tuning in. Catch you on the next one.